primary thing that I help people with is, did you make a good decision that resulted in a bad outcome? Or did you make a bad decision that resulted in a good outcome? Because the first one is fine. The second one is where the danger lies.
Welcome to the Build to Billions podcast, where we guide successful entrepreneurs and investors on the journey from millions to billions. We believe the key to scaling and compounding your wealth and life starts every single day with the mindset and practice of stewardship over ownership and applying billionaire biblical principles. Our ultimate goal is to help you scale and compound your wealth and life so you can give more or all of it away to help MVPs. My name is Brett Swartz, and I'm excited to be your host today because I get to interview an amazing individual who has tremendous experience. He's going to bring some unique insights around investing, around some unique tax strategy here. And he's from one of my most, greatest city in the world, San Diego. At least that's where he's at now. And we're going to be talking about measured risk, how to build a measured risk portfolio. Our guest is going to share all about that and so much more. Please welcome to the show with me, Mr. Larry Kriesmer. Larry, how are we doing?
Good, great. Thank you, Brett. That's an energetic introduction. Hopefully I'll keep up with you.
No, I'm sure you will. And usually I have your whole bio in front of me, but since our lines got crossed here, I don't have it in front of me. So it'd be great just for the listeners to hear a little bit more about your story and your current focus.
Yeah, absolutely. We are a registered investment advisor, RIA, and we've been in that model since 2007. And my business partner and I have been together for now something longer than 20 plus years. We measure by how old his youngest son is, because his wife wasn't pregnant with him when we got together. So it's been a long time, very successful partnership. And I started out in business as a life insurance agent, very humble beginnings. Got interested in the wealth management side of things, went through a sort of a process of discovery. And actually, we got a brief second. I'll just talk about the origin story. I mean, we were trained on building portfolios in a very traditional method, the diversification with stocks and bonds. And over time, what my partner and I realized was that most of the return was coming from our decisions on where we would allocate money, like whether it was large cap or small cap or mid cap or bonds, right? That really is the determinant of where you're going to get your return from. And not very much was coming from the managers that we referred the money to. So stock timing and selection is not particularly part of the rate of return decision. So late in the 90s, we started to take that responsibility on our own and started using ETFs to get exposure to the broad sectors and build really well-diversified portfolios. And it was in the tech bubble that burst at the end of the 90s where I got my first kind of slap across the face with diversified portfolios not doing well. And when the market started to turn south in 2000 and 2001, again in 2002, we'd get a call from a client asking, Larry, how much worse do you think this can get? And the reality was I had no answer. In fact, we were blazing new territory together. And that was really not good. It was a bad experience for the client. It was a bad experience for me as an advisor. And, it shook me because people that had taken my advice and bought the things I recommended were now, pretty much panicking. I couldn't assure them of any kind of downside limit. They watched their portfolios drop by 10% and then by 15% and then by 20%. And when they asked for help, there is no answer, or there was no answer. So that was really the crucible under which I decided as an industry and as a career, I did not want to do this again. I did not want to go through this process. And it led me to really search for a different solution. And that different solution has now manifested itself as measured risk portfolios. And I can now answer honestly and really down to a very small finite dollar amount how much risk is in somebody's portfolio. And that creates a whole different kind of experience when you go through negative time periods.
Absolutely. Larry Kriesmer, everybody, and spelled Kriesmer. You can learn and connect with him by going to measuredriskportfolios.com, measuredriskportfolios.com. Thank you for that background. Extremely helpful. Let's dive into the number one secret to building a measured risk portfolio. And maybe you kind of already shared it, is having a team that does have some answers when things are changing based upon data, based upon obviously decades of experience. But from the investor standpoint, working with you, what's the number one secret, maybe in the mindset to approach this, either this new or this novelty that you guys offer?
I think there's two things. One is that we can't know what the market's going to bring or when. We just can't. I mean, there's no way to know what's coming. But we do have some experience in knowing that long term, generally speaking, the market's going to go up. And it goes up way more often than it goes down. Now we have to contrast that with when it goes down fast and hard and way faster and way more than we expect. I mean, we do know it's capable of losing 30, 40, 50% of its value. It doesn't happen often, but because it does happen, the human species is going to get up defenses so that it doesn't suffer from that. And unfortunately, what the common response is that we add bonds or fixed income or things that are not as volatile and don't have as much capacity to go up, frankly, and also don't have as much capacity to go down. That's the blend that we're trained to use. But I want to ask you, Brett, when's the last time somebody came into a cocktail party and said, "Wow, my diversified portfolio just crushed it last year"? Nobody. Nobody says that because diversified portfolios don't have the ability to, explode in value. It's not possible.
Mm-hmm.
The people that
Mm-hmm.
get to brag at cocktail parties are the ones who have concentrated risk. They're the, call it brave or the foolish who've put all their money into Bitcoin or all their money into Nvidia or something, concentrated. That's when
Mm-hmm.
you hit home runs. Now, the problem is the people only talk about it when they are successful. There are thousands of people who have put concentrated risk into things that have gone south badly, and they don't talk about those experiences because those are painful. But the key for me is that the best way to avoid losses in equities, in stocks, is to not own stock. And simultaneously, the best way to grow wealth over time is to own stock. So how are we going to reconcile those two things? That's the question, right? And
Yeah.
exactly right. So this is hopefully going to be engaging and entertaining, but ultimately going to be enlightening as well. What we're able to
Mm-hmm.
do and what we've trademarked is the term SynthEquity for synthetic equity. So SynthEquity is an approach that we attempt to re-engineer, almost like synthetic oil versus traditional oil. We want to synthetically re-engineer the exposure to the upside of the equity market and
Mm-hmm.
engineer out the only problem it has, and that is that occasionally it'll lose 30, 40, 50% of its value. If we could do that, that would be a phenomenal thing. And that's what we have done. We've taken a playbook from an insurance product. So it's not like something we invented ourselves, but we took a play from an insurance product and we realized that if we put, let's say, an outsized allocation to treasuries, which is today the safest investment class, I think we can all agree that a short duration treasury is about equivalent to cash or cash equivalents. So we put
Mm-hmm.
about 85 to 90% of a portfolio into treasuries. Now, that is incredible that with that type of allocation, we still have a track record that shows that we can keep up with the S&P 500 with only a 10 to 15% allocation to something else. And the thing is that something else has to be wicked volatile. I mean, it has to move like a banshee. In fact, I was joking with somebody recently that Bitcoin isn't volatile enough. It wouldn't be able to keep up and wouldn't be able to move the needle with only a 10% allocation. So what we use are options, basically derivatives on the S&P 500. So we're not picking individual stocks. We're not going to claim to know, which stock has the best chance of going up or down over a period of time. We're just going to attach our wagon to the S&P 500 horse engine and whip it and let it run. And the idea is that with a 15%, let's say, allocation to options and 85% to treasuries, most everybody can do the math and figure out, well, my loss limit's about 15% because I've got 85% in something that's not going to go down in value. Then what we do that's unique is we daily monitor the amount of options that are in the portfolio. So if the options we buy go up sufficiently in the next 3 or 4 days, we'll sell those options and we'll take part of the gain, we'll buy more treasuries. And that addition topping off of the treasury raises the risk-free balance in your portfolio and maintains the full risk component of the portfolio going forward. Now, what that does over time is that within, if we're lucky, 5 years, 7 years, maybe 9 years, depending on what the market's doing, we'll have a portfolio that maybe has doubled in value. And so would somebody who owns the VOO or any other type of tradable index on the S&P 500 with one glaring difference that if the market then were to suffer a 50% drawdown, that VOO holder or SPY holder would suffer the 50% loss. We won't. We'll suffer roughly a 15% loss, the loss of the option premium. And that's about where our losses should end. Not only that, we're actually earning interest on the treasuries. So we get some additional return of capital along the way. So that, in a nutshell, is the broad recipe. Happy to share it. It's not a proprietary type of a thing. It's something that you could read about and do on your own, or you could really do yourself a lot of harm if you don't know what you're doing. So
Okay, cool. Let me sure I got this, because by the way, that was masterful. That was amazing. It sounds like you're buying options attached to the S&P, and the key here is that you could be in the S&P yourself, but your downside risk is maybe limited up to approximately 15% of a downturn if it goes down by 50, right? Or others are going down 50, and so this is let's say equal or on par with the upside. It sounds like, generally speaking, right? This would be a good to obviously figure out your track record the last 5, 10, 15 years of doing this. And then the downside is less, well less, right? I mean, 15 versus 50. Is that a fair summary, or what did I miss?
yeah, no, that's exactly correct. And there is just one sort of issue here, and that is that because options are like a lit fuse, you can't hold on to an option and wait for it to recover. An option has a certain shelf life, and when you buy it, it's headed toward expiration. So this strategy requires the market to go up. If it doesn't go up sufficiently, there is a heavy headwind. It's referred to as time decay, and it deteriorates or erodes the value of the options. It's possible in our strategy that you could have a modest positive year, like 2, 3, 4%, or even a modest negative year, minus 2 or 3 or 4%, and suffer an entire loss of the option sleeve. So it's possible to lose more than the index in our strategy, but still not more than what the risk budget is. So it's still measured risk, and it's still synthetic. And we would gladly trade that type of a dip in value for what the unhedged market can deliver, which is that 30, 40, 50% decline. It's because
so let's dive into the I'm with you. I agree. I think everyone would agree to that too. So let's keep moving here, because I think this is good. Let's give, I know past performance not a prediction of future results, right? Or guarantees or anything like that. So, but just generally speaking, the last 5, 10, 15 years, maybe talk about some of the critical, the COVID years, maybe talk about some of the other things that have come up. Just kind of curious, how have you performed versus the S&P?
Right. Well, first of all, our firm claims compliance with GIPS, which is the General Investment Performance Standard, since 2016. That's just a set of rules that allows us to talk about performance, and that's available on our website. And you'll see that under the strategies. So people can go and look at this on their own. We have a track record that is able to demonstrate that we do, in fact, go up when the market goes up. We limit losses when the market draws down. And over time, we've been able to maintain, on a gross of fee basis, more than the S&P 500, on a net of fee basis, less than the S&P 500. The best way for me to describe this is that if you were to draw a straight line from, let's say, bottom left to upper right, like on a chart of a performance, if that's the S&P 500 over time, measured risk portfolios and SynthEquity is going to corkscrew around that line. Sometimes we're ahead, sometimes we're behind. But in general, we're capturing that long-term result of the S&P 500. That's the goal, and that's been the experience of our investors.
Okay, fair enough. I think that's helpful. Measuredriskportfolios.com, everybody. Click on strategies to learn more about that. They got investor resources, white paper on the power of SynthEquity. This is their trademark, and so much more. All right, so we covered a lot there. What maybe is the number 2, either secret here or insight from an investor standpoint that would help them, get comfortable with this strategy? What's the next step in the process?
Well, I think it's that thing I alluded to early on, and that is the concentration and concentrating your risk. When you look at a traditional investment advisor or a traditional investment relationship, if you're 55 or 60 years old, there's no way that you're going to be allocated 100% to equities. There's just, no one does that unless you have like crazy high money above what your needs are. But if you're in the kind of normal range of investors, it's very likely you'll have 20, 30, 40, even 50% of your capital professionally allocated to less volatile assets, which is fair because even if equities can drop 50% and you only have 60% of your portfolio in equities, this is like the math problems we tortured ourselves when we were in high school. But 60% of 50% is still a 30% loss to the portfolio. That's even with only 60% allocated. If the other 40% in bonds does a tremendous job and earns 10%, which is a big ask, you've only got 40% in it. So it's only going to earn 4% positive return. That means your net loss exposure in a 60/40 portfolio, which is modest, balanced, is still 26%, on the kind of bad case scenario. With us, a bad case scenario is about 15%. And so we're actually able to synthetically increase the tilt toward equities and the long-term results they can deliver, and simultaneously reduce the potential drawdown risk. That's where you make big progress over the course of 10 or 15 or 20 years, is by leaning into what the market can deliver. Doesn't mean that we're going to get a positive return. There's nothing that we say or promise about the S&P 500 delivering long-term returns, except for a very, very long track record of delivering, depending on when you measure, something between 8 to 10% annualized. Again, it's obviously sensitive to when you start measuring and when you stop, but that's kind of the expectation for equities.
Okay. Yeah, I mean, this is, I think part of it is like you hire the who, don't be the how. Like your expertise in this is obviously very deep and it's technical. And at the end of the day, it's like, okay, if you had a choice between traditional way of doing it versus this, it seems like it's pretty clear that you lower the risk here and you get, equal return ish, but much lower risk. And so that's kind of the nuts and bolts that I'm hearing so far.
Mm-hmm.
If we can now shift into the tax strategy, we were talking earlier before the show, the 1256 index options and some, this is capital gains tax. I don't know what, walk us through what this 1256 is and who could take advantage of that.
Right. So I don't want to get too deep in the weeds on options and option structure, but effectively, we either trade on the SPY, which is the biggest, place that has the most liquid options trading on the S&P 500 tradable ETF equivalent. And we also trade on the actual index itself, which is SPX. The big SPX contracts, one option contract represents about $500,000, actually like $600,000 now. So it's a big allocation. You have to have a large account to be able to take advantage of this tax treatment. But if you do, then the options that we buy for that size account are given special tax treatment. It doesn't matter how long you hold the contract. If we buy it on Monday for, let's say, $4,000 and we sell it on Friday for $6,000, that $2,000 gain is not short-term ordinary. It's treated 60% long-term capital gain and 40% short-term ordinary. And it's just statutory. So that's the way that works. The other really amazing thing is that 1256 contract gains and losses can be used. The losses in a current year can be used for up to 3 prior years. So I think everybody's familiar with the idea that if you have a capital loss, you can put it in your pocket and use it going forward and indefinitely until you recoup your losses. But what's unique about the 1256 contracts is you can go back, let's say, if we had a bad year in 2022, which we did, you can go back and amend 2019, which is a phenomenal year, and apply the losses that you incur in 22 to amend your return in 2019 and get a tax refund against your 2019 tax you paid. Then, because that arrives roughly in 23, let's say early in 2023, there's still a potential that that tax refund, cash money that arrives, can be deployed into the market that might still be lower from having losses and be able to basically create a pool of additional capital to reinvest into a lower than before market. So these are some really, really phenomenal tools that are available to us in the separately managed accounts that we handle.
Okay, so let's get practical here. So someone invests $1 million with Larry and his team, and gosh, it does really great for 5 years, and it doubles, right? And so in this scenario, what's the strategy here if they now need some of that out, larger amounts? Are you gonna walk us through? I'm trying to apply it to a real life scenario. I think you bought real life stock, or you bought something where.
I think what's really interesting too is that because you've doubled the account to $2 million, but still 85% roughly is going to be now in treasuries. Well, treasuries are super liquid, right? And if you needed $200,000 or $500,000 or $600,000, we can liquidate the treasuries for hardly any nominal tax impact, because they are only just a little bit worth more than what we paid for them at any given moment. We can send that money to you typically either same day or next day. And you have like major liquidity with no tax consequences to speak of. We can then make a decision about whether or not this need for liquidity is temporary or is it permanent. If it's permanent, we'll adjust the option structure appropriately to bring down the risk to be in line with what your risk goals are. But if it's temporary, let's say you're helping a child buy a house or you have a business opportunity that's going to turn around shortly, we can actually just put a placeholder in your account and leave the option structure in place that treats your portfolio as if you didn't take the withdrawal. And obviously, if the market continues to go up, it improves your rate of return, but it's actually just keeping you in the game. If the market goes down, it's worse than it would have been had you taken the option risk off. But it's very, very flexible and very tax neutral, frankly, at that level.
Let me think that'd be another real life scenario, right? So in fact, we helped the client exit a $13 million car wash in San Diego. They basically built it for $4 million and they had this massive capital gains tax, didn't want to do a 1031 exchange. In fact, wanted to diversify into securities and Bitcoin and other real estate stuff that's passive and really get out of debt. This is a couple of years ago before rates went up. So like the timing was perfect. And so we executed on our strategy. I'm trying to figure out, well, would what you're saying, the 1256, can it be used to offset other things that are outside, or is it only within the confines of the index funds?
Yeah, it's only 1256 only applies to 1256. So you have to have 1256 gains in the past to be able to use losses now to refund them.
And just to clarify, what are 1256 gains? Like what qualifies for that?
It's index options. So cash settled options. So if you buy an option that would actually deliver shares or require you to deliver shares or get shares, then that's not an index option. If you trade an option like SPX,
so it's very niche. So what do you do in the other scenario, Larry? Like someone bought NVIDIA public stock or Tesla or Bitcoin, and they have this massive millions and millions of gains, real estate. What someone comes to Larry, I want to go into your measured risk portfolio strategy and obviously diversify and get more liquidity and less risk. What do you say, or what strategies do you typically either point them to or you've seen in the past that have worked?
Yeah, well, it's pretty rough when you have a highly appreciated position and it's concentrated and large. It's a great impact, but it kind of points out some of the struggle with having a concentrated position because you don't feel like you can use it. Touching that security triggers a big tax bite. There is no getting around that, and at least there's some complicated things where you can maybe buy into some pooled investments that allow you to sell the position or don't sell the position but diversify your holdings. Those are interesting, but they're usually you give up a lot of control and you end up being pooled with some other investment assets. Now, from my perspective, what I typically do, I'm very simple. I'm a life insurance planner at heart. That's what I was trained at. So planning to me makes sense. I just work out with the client what the annual tax budget's going to be. Just give me the pain level you can tolerate that will start peeling capital off of your position. And in between there, we can collar it or hedge it. Maybe not. Depends on the client's, vibe, frankly, to use the kids' words now. We want to see what the pain point is. If something's gone from a $500,000 investment to a $14 million investment, they may not care if it drops to 10 million because they're so far above their basis that it's still just gravy train for them. So that they don't have any will to spend any money on hedging. But if they want to protect that money, we could install a protective collar where you buy puts and then you finance it by writing covered calls. You can make this a no-cost transaction. So if the market goes up, you've got to be prepared, though, to sell off a portion of the position that exceeds the call writing. That can be where we can engineer in a amount of like a risk budget or a tax budget that we're prepared to allow to execute and help a client, get out of a concentrated position over time. Now, unless they're 80. If they're 80 or 90 and they've got some limited amount of runway on their life, then maybe it's better to hold it until they pass away and get a step up in basis.
That was masterful. And maybe replay that back, everybody, so you can kind of catch that. Couple things on this. So we had another client out of San Jose, Bitcoin, bought it for 50,000, went to 50 million. Okay. Wow. So, basis is basically 50K, 50 million. So it's one of the never sellers until she met us. And then we built a capital gains tax exit plan where we exited the Bitcoin, deferred it, and actually put it mostly into a diversified portfolio of liquid investments and securities. And it was great because Bitcoin went from 54 to 68 or 69, and then it dropped to 15,000 a coin. So she got out at a great time and was able to diversify. And that's the whole part, while still deferring the capital gains tax. Number two, without moving to Puerto Rico, right? So it's we use an installment sale method with a trust, right? Or a trustee. That's kind of our whole business. I'm curious, like publicly traded stock, we can do it with. We've done it with real estate businesses, and to us, it's that nice bridge. And you can go into insurance, you can go into real estate, you can go into, you can diversify the whole thing, right? And that's the whole point. You're no longer having to stay in this highly concentrated position, and the roadblock is typically the tax. And so we defer the tax, right? And and then they just pay tax slowly on the payment back to them over time. So when you hear that, I'm curious, what comes to mind, Larry, or what questions would you have? Someone like your expertise, like I'm sure you've heard or seen things like this. In fact, I think we work with a colleague together, David Young. He's part of our inner circle there. Yeah. Former, with Bill Gross at PIMCO, and he's Anfield Capital now. And so he works with us with these type of cases. And so I'm just curious, for someone's expertise like you, like when you hear all that, what do you think?
It's just, typically something's got to give, and I assume it's liquidity. Is there a liquidity issue in your structure?
No, because you can invest into whatever you want. Like you can put it literally into what you're talking about, and index funds and different options. You can do all that, and we diversify into different things. And really, it's like a $10 million stock. Let's just do an example. Imagine it was $1 million basis. You have $9 million gain. You sell the stock to the trust. The trust sells it to the open market. So the trust has no gain, right? And then the trust issues a promissory note. Let's just say for in public stock, it's got to be based upon the IRS actuarial tables and stuff, so about 5% or so. And then it just pays back, a certain amount over time. So in one sense, you do need to sell some stuff or get interest on certain things to pay back. But before, they had either no dividends or really no cash flow, or of course, highly appreciate it. So no, that's the beauty. You can invest in whatever you want.
Yeah. Okay. Well, then let's find out more about that.
Yeah. If people want to learn more, go to capitalgainstaxsolutions.com, capitalgainstaxsolutions.com to learn more. Okay. Let's keep going here a little bit more. What questions haven't I asked you so far, Larry, that I think would be helpful for someone who's listening, and also just talk about how you work with clients and such. Just kind of tell them a little more about you guys. Yeah.
The thing we're really looking to do right now is to work with clients' advisors. So,
okay.
I mean, we have room for additional clients, sure. But the reality is that there is much more to be done, and I can touch many more people if I can work with an advisor who has 20 or 30 or 200 clients of their own. So if you're a retail investor and you're listening to this and it sounds interesting, I'd encourage you to talk to your advisor about it. Measured Risk Portfolio does work with other advisors. We want to work with other advisors. Frankly, if I can work with your advisor, I can help maybe 100 families versus just you. So I'm happy to do that. That's a really important part for us that we're trying to make clear. The other issue is that in March of this year, we did launch the strategy, or a very similar structure based on this plan, and that's currently available on many public exchanges. So the trading symbol is SNTH, and SNTH is out there and available for basically for about $30 a share today. So
excellent. Oh my gosh.
You can put a small amount in there or a big amount in there.
Yeah. That is so helpful. And thank you for sharing that. Again, if I want to take action on that, it's really simple. Just go to measuredriskportfolios.com, share that with your advisor, connect them with measuredriskportfolios.com to learn more. That being said, are you ready for the lightning round, Larry?
Yes, sir.
All right. Knowing what you know now, if you go back to your 20-year-old self, what's the one golden nugget make sure to tell yourself to do?
Gosh, the 20-year-old goal. I would take more risk. I'm actually learning how to do it. And I've heard you ask other people about who you want to go back and see. And
who's that?
That's the question. My dad passed away about 10 years ago. And he unfortunately was a victim of financial fraud. And when he retired after 30-something years working for a big oil company, instead of taking a pension, he took the cash out process. And he gave several $1 million to a firm up in Los Angeles, or up in Northern California. This is back in the 80s. And about 18 months later, that entity had gone, south. So it ruined him. It honestly, it killed him. He didn't die then, but the man I grew up with did. And I'd love to be
Mm.
able to go back and share with my dad what we've done so that people don't ever have to have that kind of experience. Because I think, there's just such damage that happens in financial loss. And for some people, it's
Mm.
5% does that to them. Some people, it's 50%. And some people, go all the way to where they lose everything. If there's anything I can do to prevent that, that's what I'm about.
Man, thank you so much for that. That really is meaningful for me and hearing that, and I'm sure for our listeners too. Question number 2, number 1 book you've recommended or gifted the most in the past year?
It's actually Building a Story Brand. That is a great book for business owners who are, I think every business is trying to solve a problem. It's whether it's getting your clothes cleaned or cleaning up the world or whatever it is that your mission is. And if we realize that we're not the hero of the story and that we're a guide, it can really help people.
Amen to that. I love that book. It's a great book. Donald Miller. Check it out, everybody. Building a Story Brand. Question number 3. What are you most curious about right now?
Curious. I'm curious. Gosh, that's almost too big of an open-ended question. I think about things all the time. I'm curious about how we can make our country feel more cohesive. I'm curious about how we can end the conflict in Gaza and how Israel can have a place in the world. I'm curious about how we can, solve the what seems to be basic problems of human hunger. These are all things that I occupy my free time in and spend a lot of time pondering. And I'm curious why we haven't been able to do it yet.
Amen to that too. A whole other podcast episode on that, on
Yeah.
all of those. Next question: what is your approach or your take on just Bitcoin or Bitcoin ETFs?
Yeah, so I think my favorite thing about Bitcoin is the blockchain technology. I think that's going to be substantially, significantly adopted over the next, several years. I'm not as keen on the currency component or the store of value. I just think I'm not sure people really appreciate what the attack on a fiat currency of the United States could do to us in the globe. There's a certain amount of you know stick it to the man or do my own independent thing, which I appreciate. It's very American, and there's nothing wrong with that. But the real follow on could be alarming in having sort of the control of capital become not diluted, but let's say distributed to something other than a power that can control what to do with it. So I'm probably a little over my skis there, and I may generate a whole lot of hate, but that's what I feel like.
No, it's an honest and it's transparent and it is alarming on each side of it, because the other side they'd say they just keep printing so much money, keep spending, and the printing press just comes out and they devalue the dollar. So, what is your take on that side of it? Because that's the part where my brain kind of explodes when I look at it. It's hard for me to
Yeah,
look at the 37. I don't know if it's 38 trillion now. So.
yeah, we have to have a deflating currency in order to survive as a government that promises benefits that we can't afford. So, I mean, that's just a thing you have to adopt and go, okay, that's the way it has to be. I do think that, I mean, I ponder problems and solutions all the time. That's what I really enjoy this.
Mm-hmm.
I think trying to finance retirement for people in this country and ask people who are working to pay for people who are near the end of their retirement age, which was how we started this whole, Social Security game,
Mm-hmm.
is a non-starter. Any financial planner will tell you that you have to put time on your side and not put it against you. So
Right.
when we start looking at the ability to put, like, say, $1,000 away for each child that's born in the United States and invest that in something that is actually going to grow with the inflationary component of the world, not bonds, but stocks, and then
Mm-hmm.
allow that to also be means tested, so that because it is a benefit that's given and not a benefit that's extracted, we don't have to
Mm.
give it to people who don't need it. I think I mean, can you imagine that someone like I don't know, Elon Musk or Jeff Bezos probably is eligible for Social Security and is going to get a couple $1,000s a month? It's obscene. It's ridiculous, and that level is understandable. it's a political decision to figure out whether or not the number that you don't have Social Security is $200,000 a year, or is it $500,000 a year, or is it $85,000 a year? That's an amorphous number that's going to have to be talked about. But I really don't think that people that have been successful, who have contributed to Social Security, should look at that as something they should be getting back. I think you have to face facts and just go, we should allow that to be a social safety net and not a return of principal. I think that's my opinion on that.
Gosh, that's well said. And that's a complex discussion. And I imagine they the certain amount would, if they had a chance to vote it and they'd say I had made this much, I wonder how it would be voted out if they had a chance to vote it all out. But well said. We're way out of time. This has been amazing, Larry. I want to just finish the last question and then we'll wrap it up. After all your success helping all the people you've helped, how do you best keep a mindset of stewardship over ownership?
Well, so stewardship right now is an interesting thing that we're in, because the team we're building, I'm now really focused on having this be a business that outlives me. And part of that process is to give up a significant amount of the decision making and be a guide, help people make decisions and own the decisions and the outcomes. And the primary thing that I help people with is, did you make a good decision that resulted in a bad outcome? Or did you make a bad decision that resulted in a good outcome? Because the first one is fine. The second one is where the danger lies.
Wow. Larry Kriesmer, I want to just thank you. That was amazing. That was worth the whole show right there. Play that back, adopt that mindset and that practice with your team, your family, all of the above. Thank you so much for being on the show. Thank you for sharing your insight and your wisdom with us. One last time for our listeners, Larry, who want to get in touch with you, what's the best place for them to find you?
Yeah, measuredriskportfolios.com.
Awesome. Thanks, Larry. I also want to thank all of our listeners for listening or watching the Build It to Billions podcast. We're also streaming on Capital Gains Tax Services podcast and YouTube channels. And we're on this journey with you to scale from millions to billions to give more of all our way to help MVPs, the most vulnerable people. My name is Brett Swartz. Please take action today. If you have a massive exit coming up with huge capital gains taxes, you want to explore how to build a capital gains tax exit plan, go to capitalgainstaxsolutions.com, Bitcoin, business, stock, real estate, capitalgainstaxsolutions.com. And of course, look up Larry, share his wisdom with somebody that can help today, and we'll talk to you all again real soon. Bye now.